Today, we're tackling a topic that, well, it often sparks some pretty lively debate, doesn't it?
It really does.
And it can feel incredibly complex. How some of the largest, most profitable companies legally manage to pay surprisingly little, sometimes even zero, in federal income taxes.
Well,
You've probably seen the headlines, right? And it leaves you wondering, okay, how exactly are they doing that?
indeed. And our mission today really is to unpack those strategies, to look at the specific tax code provisions that allow this to happen. We're drawing from a really interesting 2013 report by the Institute for Policy Studies, 10 companies and their tax loopholes.
Right.
But we're also bringing in more recent analyses, from places like Forbes, the Institute on Taxation and Economic Policy, Ethical Consumer, Law 360, CNBC.
So a wide range of sources.
Absolutely. To show you not just what's happening, but maybe more importantly, why it matters for all of us.
Think of it as us pulling back the curtain a bit on corporate finance. You'll get a deeper understanding. And honestly, some of the numbers we're about to share, well, they might genuinely surprise you. Some real aha moments, hopefully. So let's set the stage. There's a really striking observation in that Institute for Policy Studies report. It points out that while U.S. corporate profits hit like a 60-year high,
Yeah.
corporate income taxes as a share of federal government receipts actually plummeted from nearly a third back in 1952,
Wow.
down to less than 10% by 2012. That's a huge shift, isn't it?
It's a massive shift. And what's fascinating, particularly back then, is that the official U.S. corporate tax rate was 35%. That was the number on paper.
Right, the statutory rate.
Exactly.
Yeah.
But very few companies were actually paying anything close to that. Now, that rate has since changed, of course. It went down to 21% with the 2017 Tax Cuts and Jobs Act.
Okay.
But even back then, between 2008 and 2010, the average profitable company in the Fortune 500,
Yeah.
they paid just 18.5% of their profits in federal income taxes,
So roughly half the official rate.
roughly half. And it wasn't uncommon, for dozens of large profitable companies to pay absolutely nothing in certain years, zero.
Okay, let's unpack this then. How? How do they manage that? The report says the corporate tax code is riddled with loopholes, perks, and preferences, often won by corporate lobbyists.
That's the core of it. And one of the biggest loopholes is the offshore tax loophole. This costs the U.S. Treasury an estimated, get this, $90 billion a year.
$90 billion. Wow.
Yeah. Now, originally, the idea was meant to encourage U.S. multinationals to expand business overseas, compete globally.
Okay, seems reasonable on the surface.
But tax attorneys, accountants, they found ways to really stretch this, setting up subsidiaries in low-tax tax havens, basically.
Right.
And they'd register intellectual property there, things like patents, trademarks.
So the valuable stuff that generates profit.
Precisely. And this is where it gets really interesting when you look at specific companies. Our sources give some great examples.
Microsoft.
Like Microsoft. Yeah. Between 2009 and 2011, they saved about $4.5 billion in federal income taxes
Wow.
by transferring basically 47 cents of every dollar they made in U.S. sales
Okay.
to a subsidiary in Puerto Rico, which functions as the tax haven in this context. By 2012, they had something like $60.8 billion in profits stashed offshore.
And they estimated they'd owe, $19 billion if they brought it back?
$19.4 billion, yeah. That was their own estimate. And then you have Pfizer.
The pharmaceutical giant.
Right. Despite, 40% of their sales being right here in America, by 2013, they hadn't reported any U.S. profits for 5 straight years.
None. How's that possible?
Instead, they actually claimed $2.2 billion in federal tax refunds between 2010 and 2012.
Refunds, while having huge sales here.
Exactly. And they had $73 billion in profits offshore in 2012. It shows how effectively profits can be shifted legally on paper.
It's not just tech and pharma, though, right? The banks, too.
Oh, absolutely. Bank of America reported $70.2 billion in profits offshore in 2012. And get this, 313 of its 594 foreign subsidiaries
Over half.
were registered in offshore tax havens, including 175 just in the Cayman Islands.
175 in one place, known for low taxes.
It's a common pattern.
Yeah.
Citigroup, similar story. $42.6 billion held offshore untaxed in 2012. They said they'd owe $11.5 billion if it was repatriated.
And they had hundreds of subsidiaries in tax havens, too.
Yeah. Back in 2008, Citigroup had 427 subsidiaries in tax haven nations out of about 1,200 total.
It really paints a picture. What about industrial or energy companies?
Yes. General Electric, GE, they had a staggering $108 billion in profits offshore in 2012. At the time, that was noted as the largest untaxed foreign stash of any U.S. corporation.
It's the biggest. Wow.
And ExxonMobil, $43 billion offshore. Honeywell, $11.6 billion by the end of 2012. There was one example with Honeywell booking profits in Luxembourg.
Another well-known low-tax country.
Right. Despite having no actual physical facilities there, it was just where the profits landed on paper.
So this offshore strategy, I've heard of something called the double Irish with a Dutch sandwich. It sounds kind of elaborate.
It does, doesn't it?
Yeah.
And it was intricate, but again, legal at the time. Basically, it funneled profits.
Oh.
Okay, so profits would go through an Irish subsidiary first, then they'd hop over to a Dutch subsidiary, and then finally land in a second Irish subsidiary.
A second one.
Yeah, but this second one was often based, for tax purposes, in a place with zero corporate tax, like Bermuda.
Ah, okay, so that's the final destination.
Right. And the effect was that companies could pretty much eliminate, or at least put off indefinitely, paying taxes on those profits generated outside the U.S.
Morally questionable, maybe.
It was certainly questioned by many, but legally. It was allowed until Ireland started closing that loophole in 2015. They gave companies until 2020 to transition away.
And who used this? Big names.
Oh, yeah. Amazon, Apple, Facebook, Google, IKEA, Starbucks. Lots of major global players benefited from that structure.
Okay, shifting gears a bit. Another area mentioned is the excessive CEO pay tax dodge. What's that about?
Right. So back in 1993, Congress actually tried to limit how much companies could deduct for executive pay. They set a cap at $1 million per executive.
Okay. Seems straightforward.
But there was a loophole put in, a big one. It exempted any pay classified as performance-based.
Ah, performance-based, like stock options.
Exactly. Stock options, bonuses tied to performance metrics. And this loophole essentially fueled a huge explosion in stock-based compensation.
And the cost.
Well, it cost the U.S. Treasury an estimated $8 billion a year. Because companies can deduct this often lavish executive pay. Effectively, other taxpayers cover about 35% of the cost of that compensation through the deduction.
So an example.
Honeywell again.
Mm-hmm.
In 2012, their top 4 executives got over $30 million in this performance-based pay.
Okay.
And that reduced Honeywell's tax bill by nearly $11 million. Verizon used this a lot, too.
It's essentially a subsidy for high executive pay, then.
That's one way to look at it, yes. Then there's another one, the corporate malfeasance tax dodge.
Malfeasance. Like wrongdoing. Fines.
Exactly. Fines, settlements for corporate crimes or abuses. Now, think about a parking ticket you might get. You can't deduct that from your taxes, right?
Yeah, definitely not.
But corporations can often deduct the costs of these huge fines and settlements. They classify them as ordinary business expenses.
Wait, paying a fine for wrongdoing is an ordinary business expense.
That's how it's often treated for tax purposes. Which means, again, other taxpayers effectively end up subsidizing the cost of the company's harmful behavior.
That feels wrong. Can you give some examples of that in practice?
Sure. Bank of America.
Yeah.
They deducted a $2.7 billion settlement related to abusive lending practices.
$2.7 billion.
And that deduction saved them hundreds of millions on their 2012 tax bill. Or think about the Exxon Valdez oil spill.
Huge environmental disaster.
Massive. Exxon settled the claims for $1.1 billion. But because of tax deductions, the company actually only paid about $524 million out of pocket. Taxpayers effectively picked up more than half the cost of that settlement.
Wow. Over half.
And Citigroup, similar story. They settled a $2.2 billion lending abuse case, another $158 million mortgage fraud case, that smaller $158 million case, after the tax write-offs. It only cost Citigroup about $125 million.
So taxpayers covered the $33 million difference.
That's right. And maybe one of the most creative examples was Pfizer.
What did they do?
They were convicted of a felony for illegal drug marketing, a serious charge. But they used a loophole, a dormant subsidiary, one that had never actually sold any drugs.
A shell company, basically.
Pretty much. That subsidiary accepted the felony conviction and paid the $2.1 billion fine.
So Pfizer itself wasn't convicted.
Correct. Which allowed Pfizer, the main company, to keep selling drugs to Medicare and Medicaid, which a felony conviction might have barred. It shows how corporate structure can be used to navigate these situations.
Okay, these are some pretty eye-opening historical examples. Let's maybe look at more recent applications. And some really well-known companies like Amazon come up a lot in these discussions.
Absolutely. And Amazon's story brings in some other common tax benefits, too. For instance, there's a category you could call paying businesses to do what they would do anyway.
How does that work?
Often through things like accelerated deductions for equipment investment. Think about big machinery, computers, servers.
Stuff businesses need to buy.
Right. Laws like the 2009 stimulus bill and later the 2017 Tax Cuts and Jobs Act allowed companies to immediately write off huge portions, sometimes 100% of the cost of new equipment in the year they bought it.
Instead of depreciating it over time.
Exactly. Now, the stated intent was to stimulate the economy, encourage investment now.
Makes sense.
But the reality for many companies was they simply got enormous tax breaks for investments they were probably going to make anyway.
So it didn't necessarily spur new investment, just lowered taxes on planned investment.
That's the argument critics make. And you see the impact. Look at FedEx.
Okay.
Between 2010 and 2012, they reported nearly $6 billion in U.S. pre-tax profits. But they didn't pay a single dime in federal income taxes.
Not a dime on $6 billion profit.
Nope. In fact, they claimed $5 million in tax refunds, which gave FedEx, effectively, a negative 0.1% tax rate, a $2.1 billion tax subsidy, essentially.
Negative 0.1%. And Verizon?
Verizon saw a $7.3 billion tax subsidy between 2008 and 2012, also paid no federal income taxes during that period, benefiting hugely from these kinds of deductions.
And for the banks, there was something else after the financial crisis, right? Like a second bailout.
Yeah, that's a term some used. It relates to tax loopholes for losses. After the 2008 banking crisis, many banks obviously had huge losses.
Right, from the bad loans and mortgage meltdown.
Exactly. Tax rules allowed them to use those losses incurred during the crisis to reduce their taxes in future profitable years.
Yeah.
It's called loss carry forward.
Okay, so Bank of America, for example, they got TARP money, didn't they?
They did. $45 billion in TARP loans. And then they used over $69 billion in bad loan write-offs from the crisis,
$69 billion.
which resulted in them paying no net federal income tax between 2010 and 2012. And, like FedEx, they actually claimed refunds from the IRS, $941 million in their case.
So bringing this all together, if we look at Amazon's recent tax story, these mechanisms we've discussed, they're all legal, right?
Perfectly legal. That's the crucial point.
Wow.
But their combined impact on the actual taxes paid can be, well, enormous.
And the numbers for Amazon really highlight that. You mentioned earlier, 2018, zero federal income tax. On how much profit?
Over $11 billion in profits in 2018, and they actually got a $129 million rebate back from the feds.
A rebate on $11 billion profit, and more recently.
More recently, yeah. In 2021, Amazon had a record $35 billion in U.S. pre-tax income. Huge number.
And they paid.
Just 6% in federal corporate income taxes, which means they avoided about $5.2 billion compared to the standard 21% rate.
6%. And over a longer period.
If you look at the 4 years up to 2021, Amazon's total federal tax rate averaged just 5.1% on over $78 billion of U.S. income.
5.1%. So what specific things allow Amazon to get their rate so low? We talked about accelerated depreciation.
Right. Amazon definitely benefits from things like that.
Mm.
But they also make huge use of research and development, R&D credits.
Credits for innovation.
Exactly.
Well,
These reward companies for investing in innovation here on U.S. soil. And Amazon, I mean, they have thousands of patents.
Yeah.
Cloud computing with AWS, augmented reality, Alessa's speech analysis.
stuff that drives their business.
Absolutely. And most governments want to encourage that kind of R&D, right? They see it as good for economic advancement.
Okay, so R&D credits, what else?
They're also going green credits. These incentivize investments in renewable energy.
And Amazon's big on that, aren't they?
They are. They're actually the world's largest corporate buyer of renewable energy. They co-founded the Climate Pledge, aiming for net zero carbon by 2040. They even ordered, 100,000 electric delivery vehicles from Rivian?
So tax credits for things generally seen as socially beneficial innovation and green energy?
Correct. Those are generally less controversial.
Yeah.
But then there's another big piece for companies like Amazon. It's related to stock-based employee compensation.
Stock options again. How does that work for taxes?
It's a bit of a head-scratcher for some. For accounting purposes, when a company grants stock options, they have to estimate and report the cost.
Okay, for their financial reports to investors.
Right. But for tax purposes, the rules are different. The company gets to deduct the actual value of the stock when the employee exercises the options.
And if the stock price has gone way up since the option was granted,
The deduction can be much, much higher than the cost they reported initially for accounting.
so it creates a gap between the profit reported to investors and the profit reported for taxes.
Exactly. It's often called the book tax gap. This specific provision allowed Amazon to deduct about $1.1 billion from its tax liability just in 2018.
1.1 billion just from that.
Just from that difference in how stock options are treated, it effectively lets corporations minimize their taxable income while still looking highly profitable to investors.
Okay, so that's the U.S. picture. But Amazon's a global company. This isn't just a U.S. issue, is it? How are these practices viewed elsewhere, like the U.K.?
That's a really important point. Amazon has faced, considerable criticism in the UK and Europe for its tax practices.
How did they structure things there traditionally?
Traditionally, they routed a lot of their European retail revenue through Luxembourg, another low-tax jurisdiction.
The same pattern.
Right. But international pressure has been building. There are new initiatives aimed at stopping this kind of profit shifting. And partly because of that, Amazon announced a shift. They said they'll start booking retail revenue in each individual European country where the sale happens.
So less routing through Luxembourg.
That's the idea. But the criticism remains. Ethical Consumer, for example, estimated that Amazon UK avoided paying around $433 million in corporate tax just in 2023.
433 million pounds, and they paid.
Only 18.7 million, according to that estimate.
Wow. And to put that avoided tax in perspective.
Ethical Consumer pointed out that $433 million could have been used, for instance, to recruit over 12,700 additional nurses or teachers in the UK.
That really brings it home.
It does. And critics argue this kind of tax-efficient model gives huge advantages over local retailers who do pay their full share of taxes in the UK. It sort of hollows out the tax base, as they put it.
So, pulling back again, what does this all mean? For the wider economy, for society, it's clearly not just about tax codes and numbers. There's influence, economic impact.
Absolutely. And the influence part is huge. Companies spend enormous amounts of money lobbying Congress to shape those tax laws in the first place.
Do we have numbers on that lobbying spending?
We do. From the period around that 2013 report, ExxonMobil spent over $193 million over 15 years. GE, over $284 million in that same time frame.
The huge sums.
And even just in 1 year, 2012, Microsoft spent $8.1 million on lobbying. Citigroup, $6 million. Pfizer, $10.4 million. Verizon, $15.2 million. Honeywell, $7 million.
Millions just in 1 year from each company.
Yes, and many of these lobbyists, it's worth noting, are former government staffers, former members of Congress. It illustrates that whole revolving door phenomenon in Washington.
Right, people moving between government jobs and lobbying jobs.
Exactly. And what's perhaps even more striking is how these lobbying efforts for lower corporate taxes often go hand in hand with campaigns for, well, austerity measures. Things like cutting Social Security and Medicare.
How so?
Well, many of the CEOs of these very companies benefiting from tax loopholes, are also leaders in influential coalitions. Groups like Fix the Debt or the Business Roundtable.
And these CEOs have significant personal wealth, right?
Immense personal retirement accounts, often. Examples from back then, ExxonMobil CEO Rex Tillerson had $56.2 million in his account. GE's Jeff Immelt, $59.3 million. Honeywell's David Coate, $134 million.
Okay, so very well-off executives. And their groups advocate for?
They advocate strongly for corporate tax cuts, naturally, but they also push for things like raising the Social Security retirement age, say from 67 to 70.
Which is effectively a benefit cut for future retirees.
It's effectively a 20% benefit cut for average retirees whose monthly Social Security checks are around, $1,265 or so? So there's a real contrast there.
Advocating for lower taxes for their companies, while also advocating for cuts to social programs that affect average people.
That's the dynamic highlighted by groups like the Institute for Policy Studies. Now, this raises that perennial question, doesn't it?
Do these tax cuts actually create jobs? That's always the main argument for them, right?
It is. Proponents argue that lower corporate taxes incentivize companies to invest more, hire more people, and make the country more competitive globally.
And what does the evidence say? Is it clear-cut?
Well, the evidence is actually pretty mixed. It's not straightforward. We have seen instances, quite clear ones, where companies received significant tax breaks and then proceeded to cut U.S. jobs shortly after.
Really? Can you give examples?
Sure. Back in 2004, there's the American Job Creation Act, which gave companies a tax break to bring foreign profits home. Merck took advantage, got a $4.7 billion tax break,
Okay.
and then laid off 7,000 employees over the next 2 years.
Laid off 7,000 after getting a big tax break.
Pfizer, similar story. They brought home $37 billion in profits under that same act, pocketed about $10 billion in tax savings, and then laid off 10,000 workers within 2 years.
10,000.
And remember, FedEx, GE, Honeywell, Verizon companies we mentioned, getting tax subsidies or paying very low rates, they also cut U.S. jobs during periods while sometimes growing their foreign workforces. So the link between tax cuts and job creation isn't always direct or positive.
Okay, so despite these practices being legal and deeply embedded and backed by lobbying, there is pushback, right? Efforts to reform.
Oh, absolutely. There's a growing movement both in the U.S. and internationally to address these loopholes. And public opinion polling consistently shows strong support across the political spectrum, actually, for closing corporate tax loopholes.
So what kinds of reforms have been proposed, say, in the U.S.?
Well, in the past, we saw proposals like the Cut Unjustified Tax Loopholes Act from Senator Carl Levin that aimed to do a few key things. Like treating foreign subsidiaries as U.S. businesses for tax purposes if they were actually controlled from America. Ending those big deductions for executive stock options we talked about. Closing specific subsidies for oil and gas companies.
Okay.
Any others? There was also the Corporate Tax Dodging Prevention Act from Senator Bernie Sanders and Representative Jan Schakowsky. Their approach was different, aimed at ending the deferral that lets companies avoid U.S. taxes on offshore profits until they bring the money home.
So tax global profits as they're earned.
Basically, yes. Tax global profits annually, but provide a credit for taxes already paid to foreign governments. That proposal was estimated, at the time, to raise around $590 billion over 10 years.
Significant potential revenue. And globally, what's happening on the international stage?
Globally, the big player is the OECD, the Organization for Economic Cooperation and Development. They launched a major initiative called BEPS, Base Erosion and Profit Shifting. It's basically a framework to try and realign tax rules with the realities of the modern global economy, where value is created through intangibles and across borders. It pushes for more transparency, like detailed tax reports in every country where a multinational does business.
Has BEPS led to actual changes in countries?
It was spurred action, yes. The UK, for example, implemented what they called a diverted profits tax. People nicknamed it the Google tax.
What did it do?
It imposed a higher 25% tax rate on profits that multinational companies were thought to be artificially diverting away from the UK, even if the economic activity was happening there. Australia introduced similar legislation.
And wasn't there a recent agreement on a global minimum tax?
Yes, that's a huge development. In 2021, the G7 and later the G20 countries agreed on a landmark deal, a global minimum corporate tax rate of 15%.
15% everywhere.
The idea is that multinational corporations would pay at least 15% tax on their profits, regardless of where they put them. If they pay less in a tax haven, their home country could top up the tax to reach 15%.
Is that actually being implemented?
Countries are starting to implement it now. Germany, Australia, others are moving forward. Australia has also done something else interesting. They enacted name and shame laws.
Name and shame.
Yeah, forcing large multinational companies to publicly disclose detailed tax and financial information. The idea is that transparency and public pressure can also drive change.
Speaking of public pressure, have we seen that work? You mentioned populist victories earlier.
I think the prime example has to be the whole Amazon HQ2 situation. Remember that?
Oh, yeah, the big contest where cities were offering massive incentives for Amazon's second headquarters.
Exactly. Amazon was courted by hundreds of cities. New York offered huge tax incentives, billions potentially. It looked like a done deal.
But then
there was this incredible groundswell of public opposition in New York. Activists, local politicians, community groups, they argued the cost was too high, the process wasn't transparent, the benefits were questionable.
And Amazon
eventually just canceled its plans for New York. Pulled out. It was really seen as a moment where, as one source put it, everyday Americans can have more say in this country than the richest man in the world. Public pressure made a tangible difference.
So we've really covered a lot of ground here in this deep dive, from the complex strategies like offshore profit shifting.
And the double Irish.
Right, to executive pay deductions, leveraging stimulus bills, even deducting settlement costs for wrongdoing.
And we've highlighted the sheer scale of the money involved. Billions, even hundreds of billions, held offshore or shielded from tax. Plus the powerful lobbying that works to maintain these structures.
And that ongoing debate about whether these tax breaks actually lead to jobs or just higher profits and maybe job cuts?
Exactly. And while the methods used are by and large legal, the so what question remains really significant. What's the impacts on ordinary taxpayers, on funding public services, on the fairness of the system overall?
What seems clear, though, from the reform efforts and things like the HQ2 story, is that information, transparency, public awareness, they are starting to play a bigger role.
They absolutely are. Public pressure and international cooperation are definitely shaping the future of corporate taxation in ways we haven't seen before.
Which really leaves a final thought maybe for you, the listener, to consider.
As governments here and around the world keep trying to adapt, creating new rules like the global minimum tax, how do we strike the right balance?
The balance between, say, the stated goal of encouraging companies to innovate, to compete globally.
And the collective need we all have to fund vital public services, schools, roads, healthcare, you name it, and just ensuring a basic sense of fairness in who pays what.
It's a huge challenge, isn't it?
It is, and it's one that ultimately affects every single one of us.